Stephen Horne is now CEO of Wingspan Portfolio Advisors, and he joins us now from Dallas. Steve, great to have you with us to shed some light on these hearings and what to expect. You know, a lot has been made, and we've been watching the hearings very closely. I was in D.C. yesterday. A lot has been made about who is at fault, right? Is it Wingspan? Is it Citigroup? Is it these mortgage lenders? This time around with Fannie Mae, were they essentially at the heart of this housing meltdown?
Well, I think it's a little more complex than that. Fannie Mae was built and facilitated a structure which worked well for many decades, but as long as the percentage of the portfolio that was seriously delinquent stayed well below 1%, the traditional model that Fannie Mae was at the heart of worked. But what we clearly see in the current economic circumstances is that the limits of that system have been pushed, and it has fallen apart.
Well, what did you see? Tell me exactly when. I know you only worked there a year, but at what point did you see that it was not working?
Well, you could see throughout 2006, really into 2007, the growing increase in non-performing loans, starting particularly with the lower credit quality assets, the subprime loans, and then over the last couple of years that has spread up the credit spectrum into prime loans. The heart of the challenge, though, for the industry as a whole is that there's a disassociation between those who own the credit risk, the investors,
right,
and the servicers who are responsible for resolving those delinquencies.
And you were working on the servicing side, Stephen, so you saw a lot of what was going on there. And what you say is that actually Fannie and Freddie didn't have the power over these servicers that you might have expected from these two agencies that had such a hold over the mortgage market.
That's correct. Well, there was a constant tension there between the buy side and then the servicing side, because the risk was always that if any particular investor was too stringent in their requirements on the servicer, they would lose the origination business.
Okay, well then give me a sense, as you were talking to these Fannie Mae executives and you were telling them, or you were discussing sort of the risks in this market, you say that essentially you talked to 3 different executives in 3 different cities at 3 different times, and all of them assured you that yes, you know, we've got these problems, but look, you know, Fannie and Freddie are a little bit different, you know, we're guaranteed by the government, we've got this moat, this insurance essentially, and that's exactly what went wrong, right?
Absolutely, you could see that there was a sense that the very strong degree of confidence that the quasi-governmental monopoly that they have enjoyed protected them from the economic consequences of actions, and you know, clearly we see that that was not the case. That
was not the case. Okay. Well, then today, what do you want to hear from your former boss, Daniel Mudd? What do you want to hear from him?
I think there's an interesting opportunity here where we can really take advantage of this crisis and make a better model going forward. And what I would like to see is better alignment between those who are responsible for servicing the loans and those who are holding the risk. The majority of my career, I've operated in companies that owned their loans. And the way you service loans when you own the risk is dramatically different than when you're servicing somebody else's risk. The compensation models just aren't quite right in the industry, and I think there's several different options on the table that could improve the model. Okay, all right, we'll certainly be listening for some of those discussions on those options. Stephen, thank you so much for joining us. Stephen Horne, who is the former director of risk servicing strategy at Fannie Mae.